afternoon to those of you in Europe and elsewhere. Thanks so much for joining us today for this Investor Alliance webinar on the investor responsibility to respect human rights. My name is Paloma Munoz, and I'm the Program Director of the Investor Alliance, an initiative that was formally launched in May of last year by ICCR, and whose diverse membership of institutional investors represents over $3 trillion in assets under management. The goal of the Alliance is to provide a platform for investors to engage companies on human rights due diligence and access to remedy, as well as to engage governments, multilateral organizations, and standard-setting bodies to make sure these create environments that enable responsible business conduct. While the Alliance is relatively new, as many of you know, investors have been engaging companies either individually or collectively on human rights issues since the early 1970s, including in relation to issues like apartheid South Africa, conflict minerals, human trafficking, and more recently calling on companies to adopt the UN Guiding Principles on Business and Human Rights and use the UNGP's reporting framework developed by Shift and Mazars. However, a recent report by the UN Working Group on Human Rights in Business, tasked to ensure the implementation of the UN Guiding Principles on Human Rights in Business, found that too many companies are ignoring their human rights responsibilities and called on investors to implement human rights due diligence in their own activities and to press companies to do the same. So with this context in mind, today's webinar will explore the investor responsibility to respect human rights in line with the guiding principles and in line with the OECD's guidance on responsible business conduct for institutional investors. We are excited to have Barbara Bielik of the OECD and Rachel Owens from Global Witness as expert speakers for this discussion. We're also fortunate to have Michelle de Cordova of NEI Investment, Sabrina Ritosa Fernandez from Sycamore, and Lauren Compere from Boston Common to help lead the discussion from an investor perspective. Before handing it off to Michelle, just a couple housekeeping notes. First, we will be recording the webinar and sharing the link to the recording in the coming days. Second, everyone will be muted during the presentation. That said, if you have questions, please raise your hand, I think in the right-hand side of your screen, and my colleague Mary will unmute you so you may ask your question. Another option is to type your question in the questions box on the right-hand side, and I will read that out later during the discussion part of the agenda. So with that, I'd like to invite Michelle to get us started.
Thank you very much, Paloma. Good morning from Vancouver, good afternoon or good evening to you, wherever you may be. My name is Michelle de Cordova. I'm the Director of Corporate Engagement and Public Policy at NEI Investments in Canada. We've got 30 years of history in the responsible investment space, and we operate a responsible investment policy across our fund complex. I've been asked to speak today as a member of the steering committee of the Investor Alliance for Human Rights. As Paloma's explained, it's a collaboration of investors with other human rights stakeholders to stimulate the adoption of human rights due diligence as set out under the United Nations Guiding Principles framework, and to stimulate that adoption both by investors and by the companies they invest in, as well as creating an environment that enables responsible business conduct and allows all companies to respect human rights through policy work. Perhaps you can take me to the next slide, please, Mary. Yeah, I think this picks up on what Paloma and I were saying about the goals of our alliance. If we go to the next slide, I can give you a few examples of the work that the Investor Alliance has been undertaking. We're working on publications to help in the integration of human rights due diligence by investors and by portfolio companies, and conducting workshops and panels on that issue throughout the year. And we've been active in policy work in the past year with submissions to the UN, panels at human rights fora, and also submitting to the International Financial Corporation on draft principles for impact investing. So today we're going to be hearing about the OECD's guidance for institutional investors, which integrates the UN guiding principles on business and human rights. And we're going to be thinking about how the responsible business conduct approach outlined in that guidance applies to investors. At NEI, we've been exploring how our very long established environmental, social, and governance evaluation and engagement systems can respond to the UN guiding principles and the OECD's guidance for institutional investors. I can give you, I won't tell a lie, it's a challenge. One word of encouragement I can give, that any investor that has been working on trying to integrate ESG to its processes and attempting to undertake engagement on ESG issues and touching on human rights in that work certainly has the makings of a process to respond to the guidance. So that would be my word of encouragement. The one thing I would also like to point out, however, is that there is one significant difference between the approach to human rights under the more traditional ESG concept, as opposed to the responsible business conduct concept that is outlined in the OECD guidance. I'd say that under traditional ESG, we focus on materiality in the sense that we are thinking about how environmental, social, and governance issues impact the companies that we're invested in, and hence ourselves as investors. The big difference within the OECD approach is a focus on the impacts to the rights holders, the people that are affected by the environmental and social impacts. And there we're becoming familiar with the idea, particularly in the human rights space, of talking about the salience of human rights in a particular situation. That those salient issues for the rights holders and the material issues for the investors, they may often overlap, but I think a very interesting point of challenge is the point at which materiality and salience diverge, and how the investor is going to react in that particular space. So Mary, if you could give the next slide. I wanted to conclude this introduction by saying a word about the linkage between human rights and the Sustainable Development Goals. Now, many of us in the investment space, including NEI, are thinking about how we can align our ESG work with the Sustainable Development Goals, which are a set of 17 global goals endorsed by the United Nations to address poverty and environmental issues, with a target of making substantive progress by 2030. The Sustainable Development Goals, I'm glad to say, have created a lot of interest in the investment community. You'll note there's no human rights goal in the SDGs. That's not because human rights is seen as unimportant in this framework, but because human rights actually runs as a thread through all the goals. You'll see on this slide the linkages that can be found with the various targets under these goals and the issue of human rights. And it runs as a very, very strong thread through the SDGs. I feel that the OECD guidance is an underpinning for work on the SDGs. From my perspective, the OECD guidance asks us to do no harm as an underpinning for then attempting to make real positive impact by attention for the SDGs. So I think they go hand in hand in a strong ESG approach. So I'd like to turn it over to the next speaker at this point.
Great, thank you so much, Michelle. We'll get started then with Barbara from OECD. Barbara, please go ahead.
Hi, everyone. Can you hear me okay?
Yes, very well.
Okay, excellent. Mary, could you please go to the next slide? Great, thank you. So as Paloma mentioned, my name is Barbara Bielich, and I'm a legal expert with the OECD, working in the Responsible Business Conduct Unit. And today I wanted to tell you a little bit more about our work on RBC in the financial sector and the due diligence approach that we developed under this work. Next slide, please. As an initial introduction, I'm not sure if everyone on the line is familiar with the OECD and the OECD guidelines for multinational enterprises. So I just wanted to spend a quick minute introducing that. Basically, it's the RBC unit, the Responsible Business Conduct Unit at the OECD. Our primary objective is really promoting and implementing the OECD guidelines for multinational enterprises. And it's under this work that we've launched a specific project on the financial sector. But the guidelines themselves are a legal instrument that's been adopted by 48 governments. So that's the 35 member states of the OECD, plus an additional 13 non-adherent governments. And it's probably the most comprehensive international standard on responsible business conduct out there today. So there's a chapter on human rights that aligns with the UNGPs and also with the ILO M&E declaration, but then it goes beyond that to also cover other issues of responsible business conduct, including environment, employment and labor issues, consumer interests, science, technology, bribery, tax, competition, and disclosure. So it's pretty vast in scope. The interesting thing also about the guidelines is it's also equipped with a non-judicial grievance mechanism known as national contact points. So every government that signs up to the guidelines also commits to establishing a local agency where individuals, organizations can bring complaints or issues where they feel companies operating in or from that territory are not respecting the recommendations of the guidelines. And to date, there's been around 450 cases handled by the national contact points globally. The guidelines are an old instrument. They were first introduced in 1976, but they've been updated 5 times since then, most recently in 2011. And 2011 was a very important update of the guidelines because it was then that the human rights chapter was first introduced. It was also the first time that this expectation of due diligence across an enterprise's own activities, but also across business relationship was introduced. And that the language of due diligence aligns with that in the UN Guiding Principles. So what it did is to really expand the scope of responsibility of businesses, asking that they not only think about their own activities and make sure they're not contributing to harm, but also think across their business relationships and value chains. Next slide, please. So we've been hearing a lot about due diligence these days, particularly in the past 5 years, I would say. It's sort of a hot agenda in the global policy space. And we're seeing it introduced not only in terms of international policy, but also domestic regulation. The first example of this was the introduction of the Section 1502 of the Dodd-Frank Act in the United States that called on all companies listed on U.S. stock exchanges to conduct due diligence to make sure they weren't using conflict minerals in their products. But since it's really grown to more general due diligence expectations. So you've seen in the past 2 years, both the UK and Australia have introduced regulation calling for mandatory due diligence to ensure companies are not using modern slavery in their supply chains. But France introduced a few years ago probably the broadest regulation on due diligence, calling all companies over a certain size to conduct due diligence in alignment with the OECD expectations, so across different risk areas. A few other countries are also looking to introduce similar expectations, and this is, of course, applies to investors and financial institutions as well, above a certain size. I think Rachel will get into this in more detail, but the EU is now also considering what due diligence expectations should look like for investors in the financial sector more generally. So in addition to global policy, this is something that has kind of grown some teeth in recent years also as governments have decided to make this a mandatory expectation of businesses. But I should note it's not sort of all push. There's also some pull in terms of due diligence and why investors should be implementing it. One is that there's been increasing demands across beneficiaries, particularly amongst millennials who are asking for more responsible portfolios and being explicit about the fact that this is something that they want and expect in terms of their money managers. And also because there's more and more empirical evidence showing a link between high sustainability practices and commercial returns, which I'll get to in a little bit. Next slide, please. So as I noted, the OECD is doing specific work on the financial sector. This is because the language in the guidelines on due diligence, it's actually quite high level. And this summer we did develop a general due diligence guidance that's applicable across all sectors. But because every industry and every sector is unique, there'll be specific challenges and also considerations on how to implement due diligence across sectors. So we launched work on responsible business conduct in the financial sector about 3 years ago. And under this work, we're looking at specific categories of financial service providers and seeking to develop broadly supported approaches on due diligence. So the first sort of deliverable that we've released under this project was our work on responsible business conduct for institutional investors. It's available online, but this paper really explains, translate what the expectations of the guidelines mean for both asset owners and asset managers, and then also describes practically how investors can be implementing the due diligence approach. This work was really important because when we started it, there was really a gap in understanding of what the guidelines meant for investors. And if you read the language of the guidelines, they're really targeted more towards product-oriented industries. So they talk about buyers and suppliers and supply chains, and how that translates to service-oriented industries like the financial sector was quite unclear. As a result, at the beginning of this process, a lot of institutional investors felt that these recommendations weren't necessarily relevant to them and that they didn't need to be doing due diligence in the context of their investment portfolios and vis-a-vis the companies they invest in. So one of the most important outcomes of this process was really clarifying that that is indeed the expectation and getting investors aware of that. And then the second was, of course, developing sort of good practice in terms of what due diligence looks like. And that's really the core of this paper, describing specific actions investors can be taking and then also considering specific issues they might face that are specific for the sector. So for example, one way in which the sector is unique is that because institutional investors often take a global investment strategy where they diversify their portfolios and have them reflect certain markets, they have the potential to be exposed basically to the universe of adverse impacts that companies might be causing or contributing to. It's different than some of our other sector work, garment, for example, where there's very obvious salient risks associated with that sector. Investors sort of have to think about everything. So how to prioritize that, how to make a strategy, that's one of the issues that they need to think about in more detail here. And so this work really sought to think about some of those key questions and how to resolve them, working closely with leading investors. I should note currently we have ongoing work trying to resolve the same issues in the context of general corporate lending and underwriting activities for banks, and that paper should be available in the first half of this year. Next slide, please. So what is due diligence? I've mentioned it already a few times. Really, due diligence is the process by which companies should identify, seek to prevent and mitigate, and account for how they address any adverse impacts, both in the context of their own activities, but then also across business relationships. So it's really a risk management tool by which companies can both know and show that they're acting responsibly. It's not a standard, it's not a substantive standard in the sense that we, under the due diligence process, don't include benchmarks with regards to social environmental standards, but it is a standard process. Next slide, please. And just to kind of bring this to life a little bit, I wanted to describe what the 6 steps of the due diligence process are and how they translate in the context of institutional investments. So as I mentioned, this summer we released a general due diligence guidance that seeks to identify sort of what are really the baseline concrete practical actions that fall under each of these steps. But we also undertake sector work under 5 projects to refine those recommendations for specific sectors. So the first step of the due diligence process is really embedding responsible business conduct into policies and management systems. This means having a policy on what you're doing with respect to salient risks and also how you carry out your due diligence. And then it also means making sure that due diligence and also responsible business conduct is not siloed in a peripheral or separate unit of an enterprise, but really made a central part of the activities of an enterprise. So in the context of investors, this means getting decision makers in terms of investment teams involved and thinking about how to integrate these issues really in terms of both risk identification and management and then final investment decisions. Identification and assessment of adverse impacts is the second step. In the context of investment, this means initially screening portfolios to identify general areas of risk. And investors already do this to a large degree using market research services such as RepRisk and Sustainalytics to understand a little bit where the hotspots are, and then doing more in-depth assessment to better understand those risks. And that can happen through engaging with management of companies, doing further stakeholder engagement or independent analysis. The third step is what do you do when you actually identify impacts? How do you respond to them? And this is probably the most important aspect of the due diligence process. And how you respond to risks that you identify in the context of your own activities and business relationships will really depend on the relationship to the impact and also the type of risk at issue. In our paper, we recognize for institutional investors, there's really a broad range of approaches that might be appropriate. It might involve active engagement with the investee company to communicate expectations. It might involve using voting rights at shareholder meetings to raise issues about certain risks. For very severe risks or in specific severe contexts, it might involve divesting or temporarily divesting from an investee company while they mitigate an issue or introducing exclusionary policies. And it can also involve engagement in sort of long-term advocacy or collaborative approaches that seek to address systemic risks. And I think the Investor Alliance is an interesting example of that. And then tracking is really just monitoring your processes to ensure that they're achieving the results you like and making sure that where there's shortcomings, processes are improved. And communication is about both publicly communicating on due diligence approaches and how adverse impacts are responded to, and in certain cases, in severe cases, communicating directly with impacted stakeholders. This is a little less relevant in the context of institutional investors because there'll be fewer situations where investors are directly causing or contributing to harm the level investee companies. And lastly, this is actually an independent expectation of responsible business conduct, and the third pillar of the UNGP is that providing for or cooperating in remediation is important to closing the loop. So where an enterprise is actually causing or contributing to an impact, they're expected to remediate that impact or cooperate in remediation. Again, in the context of our investor work, we address this less because we recognize that in most cases, when we're talking about investee companies, there'll be a directly linked relationship. And in those contexts, there isn't an expectation that an enterprise remediate. But of course, even business relationships can often support remediation processes by providing relevant information or again, encouraging their business relationships to remedy where necessary. One thing I just want to say about all these different steps in the context of our recommendations for institutional investors is they're really meant to build on existing practice. So we don't seek to reinvent the wheel. We want to highlight good practice where it's already occurring and introduce some sort of standardized framework for how it can be compared across investors. Next slide, please. So now I just wanted to highlight a few ways in which our due diligence approach varies from sort of traditional due diligence. And the first is that prioritization in terms of where you dig deeper for identifying impacts, and also where you apply resources to actually engage with companies or respond to those impacts, is based on the severity of risk. And this is based on the scale, which is basically how grave is the risk, how significant, the scope, so how many people will it affect, how much land, how much of your portfolio is it relevant to, and its irremediable character. And importantly, this logic is independent, I guess, of commercial impacts. And for some investors, this might represent a bit of a paradigm shift, because often the way risk is measured in the context of institutional investors will be based on commercial impacts. Next slide, please. That being said, though, so that was actually like a difficult issue to resolve in the context of our process. But as I noted previously, we're seeing more and more research and data out there showing a very strong link between strong sustainability performance and commercial returns. So something we discussed with our advisory group in development of the paper was the fact that in most instances, applying a due diligence approach that prioritizes based on external risk should not in any way contradict also the duty of investors to create returns for their clients. In most cases, the two will reinforce each other. On this point, I mean, this is specifically a challenge for investors based in Commonwealth countries in the United States, where there's narrow interpretations of fiduciary duty in the laws. So we're seeing, at least in the case of the EU, and I think Rachel will talk about this a little bit more, a move by regulators to be more explicit about the fact that considering environmental and social issues should not be considered as going against fiduciary duties. Next slide, please. Another important aspect of the due diligence approach is that it's not a compliance approach. So perfect results are not sort of the expectation of the process, but it's meant to really focus on progressive improvement. So for an investor that's really just starting out in developing these strategies, it might mean, you know, focusing on certain risks and over time broadening those out, and ensuring that over time you're identifying risks with respect to a broader piece of your portfolio and engaging with more companies. But again, we recognize that issues might still arise despite best efforts. It's really about then reacting to those appropriately and refining due diligence processes. And it's also about avoiding de-risking strategies. So we don't want investors or banks to avoid high-risk areas completely, but we want to make sure that they're investing in them responsibly. So instead of just exiting, it's about staying engaged and assisting to the extent possible investee companies to behave responsibly versus just divesting as a first step. Next slide, please. And then I guess the most important aspect of the due diligence process and how it differs from compliance or traditional due diligence is this concept about seeking to prevent and mitigate impacts. So actually doing something about it. And this is another reason why we developed this guidance and why we're focusing on the financial sector specifically, is that the financial sector has potentially a lot of power to drive good behavioral practices in the context of underlying companies. So here, the slide was prepared by Preventable Surprises, but it just gives an overview of basically comparisons of national GDPs with assets under management of large institutional investors. You can see, to a large extent, investors in terms of financial power can be on par with national governments. So they're sending signals in terms of expectations of responsible business conduct that can have a real powerful effect on the ground. And we've seen examples of this in the context of our own national contact point system. Next slide, please. I wanted to end by just giving maybe a few examples of cases we're seeing involving investors in the financial sector in the context of the national contact points. One interesting piece of information is that in the past 3 years, the financial sector has been the most prevalent sector with respect to cases brought to NCPs, accounting for about 20% of all cases that we get annually. And prior to that time period, which is prior to basically the launch of our work on the financial sector, that number was about 7%. So we're seeing stakeholders really recognizing that leverage power of the financial sector and trying to take advantage of it. A few cases that we have ongoing currently that are quite interesting. One involves Credit Suisse's financing of the Dakota Access Pipeline. It's being considered by the NCP of Switzerland. And the argument is basically that Credit Suisse did not apply adequate due diligence or respect stakeholder engagement recommendations of the guidelines in providing financing to that project. So that case is ongoing. It's quite sensitive. Obviously, Credit Suisse is adherent to the Equator Principles. So thinking a little bit about what those issues mean in the context of project finance is something the Swiss NCP is doing. We have another case at the Dutch NCP that involves ING's climate risk policy and reporting. And basically, it's about how banks should be measuring and reporting climate risk, not just in the context of their own activities, but also across their clients. And this is obviously something there's been a lot of discussion about. Broadly, it goes beyond human rights risks, but is very much linked. And something that there's a lot of work being done with also in the EU in terms of developing standardized methodology for measuring and reporting on climate risks for the financial sector. And we recently had a case closed involving ANZ Bank's investment in Phnom Penh sugar plantation, which was linked to environmental and social impacts on the ground. The final statement the Australian National Contact Point released with respect to that case was quite strong, in that they noted that it's difficult to reconcile ANZ's decision to finance a project with respect of the guidelines. So they gave a lot of recommendations on how their due diligence processes could be further improved. And then at the top here, I have just some images indicating a few cases which didn't target investors, but where investors got involved and really had a very active role in getting to a good result in those cases. So the first one involved Mylan Pharmaceuticals, which the case was about the fact that some of the products Mylan was selling were being used for lethal injections in U.S. prisons. A bunch of Mylan's investors got involved during that case, and as a result, Mylan really changed its due diligence policies and also stopped sourcing to those vendors that were reselling to U.S. prisons. The case that kind of started this whole project and really revealed these gaps in understandings in terms of investor expectations of due diligence was a case involving NBIM and their investment in POSCO, which is an Indian steel processing company with operations in the Odisha province of India. So that case raised environmental issues that were ongoing with respect to that plant. And a few years after that, NBIM introduced an exclusionary policy against POSCO, and POSCO actually eventually pulled out of the Odisha province where their operations were linked to a lot of issues on the ground. And lastly, another very well-known case in the context of the NCP system involved an oil exploration company that had a license in the Virunga National Park of the Democratic Republic of the Congo, which is actually a World Heritage Site, protects gorillas. Likewise, in that case, investors of the oil explorer got involved, SOCO, and they convinced them to exit the park, but also to introduce a commitment not to enter World Heritage Sites going forward. So those are a few sort of interesting examples of how we've seen the work on the financial sector intersect with our national contact point mechanism. I just wanted to close that also, in addition to trying to build on existing practice, we're engaging closely with other initiatives seeking to define expectations of RBC for investors. And in that way, we're really trying to promote alignment in approaches to make sure that investors are not bombarded with a lot of different initiatives and a variety of different expectations. This is a sector where this is sort of a new and growing area of interest, RBC. So there's a really good opportunity to have collaborative and cohesive approaches. So we really appreciate also Investor Alliance getting us involved and working closely with all of you. Thank you.
Thank you, Barbara, for really doing a great job at sharing what the standards are and also highlighting some of the risks of not implementing the standards and the guidance that the OECD has developed, as well as opportunities of doing so. So I think that that's really great. There's been a lot of questions come up since over your presentation. We will get to questions after the next speakers, but I've included them now in the box for you, Barbara, to take a look at and have a think about how to answer those later. Now we'll move on to Rachel, who's really going to help us get a perspective from the European context on how the EU and others are trying to implement the RBC standards around investor due diligence in the European context. So with that, Rachel, please take it away.
Thank you, Paloma. And can everyone hear me okay? Yep. Brilliant. Okay, great. Thank you. So exactly, my name is Rachel Owens, and I work for an organization called Global Witness. For those of you who don't know who we are, we're an international NGO that has a particular, I'd say, model of advocacy and campaigning, which is to do quite in-depth investigations in various parts of the world, and then to kind of expose those in the national and international media, and then to build policy and advocacy campaigns on the back of that. So some of our kind of famous campaigns are around conflict minerals and blood diamonds, and also getting a lot more transparency in the oil sector. But today I wanted to talk to you about a campaign we've been leading for over 4 years now around investor due diligence. Mary, if you mind going to the next slide. Thank you. Yeah, so I think Barbara did a fantastic job to kind of really set the scene of what the OECD guidance provides in terms of guidance for investors. And also in the last part, really identified, why this is so important. And I just wanted to touch on that a bit more, just to extend on that, particularly using some of our case studies and some of the work that we have done, and why we as an organization together with allies work on this issue. And then what I'm going to go into is discuss some really exciting developments that are happening here in Brussels. I'm based in our EU office in Brussels, and really kind of maybe a bit of a call to action at the end to see if there are any investors on this line that would be interested in getting involved in a positive way in that campaign in the EU. So as I said, Global Witness has been working on this for over 4 years. And the way we actually got into this subject is through, again, a lot of our investigations, particularly in Southeast Asia, but also in the Democratic Republic of Congo, as Barbara already mentioned, with the Virunga National Park. And one of the things that we really saw was we tried to effect change on the ground, be it in Cambodia, Vietnam, in the Democratic Republic of Congo. And we had limited leverage, to be honest, on the companies that were on the ground, causing vast human rights abuses, land grabbing, people losing their land, mass environmental damage. And one of the reasons for that was because they weren't feeling any pressure from the people who were actually kind of providing them with the finance. So then we started to look into a lot more detail into a particular study of two Vietnamese rubber companies that were causing, as I said, major issues in Cambodia and Laos. And what we noticed was there was a very important European investor who had multiple $1 million shares in that company, and it was Deutsche Bank. And we were quite interested in this because we thought, well, surely they must be aware of these risks. I mean, it was incredibly public. We had done a report. There was lots of news articles, and we felt that even just a simple Google search would enable an average investor to be able to be aware of these environmental, social, and governance risks. And we actually engaged directly with Deutsche Bank on this particular case study. But what we realized was that it was actually a systemic issue, that many investors were actually not conducting this due diligence, or, as Barbara mentioned, they were conducting it mainly from a materiality perspective. So what's our kind of bottom line profit, as opposed to, obviously profit is important, but also to what is the impact to people and planet of the actions of investors and the companies and the projects they invest in. So what we were really interested in is trying to establish a global standard for a framework for this due diligence, or environmental, social, and governance due diligence, that we believe institutional investors should be conducting. So we worked closely with the OECD and other stakeholders on the guidance that Barbara has already mentioned. And I think that a really important point to mention about that is it was a tripartite process between member states in the OECD, a number of major institutional investors, including many European ones, and civil society organizations. And what we believe was the end result was a really good kind of compromise, which both talked to the needs and the day-to-day running of institutional investors. So it's a sector-specific, in that sense, guidance, but it also talks to the wider responsible business conduct role of institutional investors around the world. Mary, can you go to the next slide, please? So around 2014, we started a campaign in Brussels, in the EU, to try and establish a legal framework for the same kind of due diligence that we see in the OECD guidance, so this kind of 5 or 6 step process that Barbara already talked about. And around 2017, there was a really exciting opportunity because after the Paris Climate Agreement, and with the establishment of the SDGs, the Social Development Goals, Europe was really keen to show the leadership on this and to work out what role the financial sector, which is obviously in the EU, you've got a very strong financial sector in many of the member states and across the whole jurisdiction, and what role that financial sector could play in ensuring that the European Union, both internally and globally, was a global actor on achieving these really important sustainability challenges that we currently face. So in March 2018, the European Commission, which is like the EU civil service and the institution which puts forward legislation, set forth an action plan on how to finance sustainable growth. And this really set out a relatively ambitious program, I'd say. Although we did see one of the major things that we saw that was missing was really galvanizing on the work that the OECD had done to have a clear obligation for institutional investors around their ESG risks. Then in May, there was a legislative package that was brought out. So this was 3 different proposals for changes in EU law around investors. And I'm going to focus on a particular one, which is called the Disclosure Regulation. And the whole thought behind this was, as Barbara mentioned, to kind of redefine what the duties of institutional investors are when it comes to environmental, social, and governance risks. What the Commission actually came out with was more of a disclosure regime. So what should investors be disclosing to the public and their end investors in terms of their, actually, to be honest, their due diligence processes. But what it didn't include was an actual obligation for investors to conduct that due diligence. So for those of you who, I won't go into detail of EU policy making because I would make you go to sleep, but what I'll just point out some kind of highlights. And so at the end of last year, the European Parliament, which is, let's say, 50% of the policy-making, decision-making process, decided to back a mandatory due diligence regime in line with the OECD guidance. And they also backed a definition of environmental and social and governance risk, what's called sustainability risk in the legislation, which talks about both financial and non-financial risks. So a bit like Michelle was talking about earlier in terms of the materiality, salience, and discussion. And we were obviously very supportive of this move because we really feel that having a very clear level playing field and a legal framework for investors will mean that it's a way to take the OECD to a next level and to have a lot more legal clarity around what the roles and responsibilities of investors are. So that legislation is currently being negotiated between the governments of the member states and the European Parliament. Mary, if you go to the next slide. So the stage that we're at now, we could have a situation in the next couple of months where the EU steps into its legal framework, a flexible yet mandatory regime for institutional investors. And as I said, we are very supportive of this move. We feel that it's really important if we are trying to, as a global community, deal with the challenge of climate change, and also to make the financial sector more responsive to the kind of social needs that are arising. But also, as Barbara mentioned, that a lot of these risks do become material. I mean, in the case study that I mentioned, that's in our report entitled Rubber Barons, the shares of the company dropped by 10% when our report came out. And obviously that has a direct impact on the institutional investors that were invested in that company. And that's just one example. And I think it's as Paloma mentioned, it's a mixture of protecting yourself as an investor, but also and providing kind of global leadership on these issues. But also it's about a deeper understanding of the companies and projects you're investing in, and engaging more to understand how you as investors can help those companies act more responsibly. And I think the Virunga example is a really good one. We released a report in September last year called Indecent Exposure. And actually in that report, we highlight 4 different case studies involving European-based or EU-based investors that were sometimes unintentionally bankrolling projects and companies that were causing human rights and environmental abuses. And what was really interesting was you had a whole range of different behavior from investors. And actually those that already had very kind of strong processes, due diligence processes, you had this very strong evidence to basis of all of their engagement. So I'm thinking here, for example, of Aviva in Virunga and engaging with Soko, this oil company that wanted to drill in Africa's oldest national park, which is a World Heritage Site. And I think that is one example of how investors can use these due diligence process to affect positive change, but also protect themselves from risk. So the point of me really being on this call is to appeal to those investors that are listening, and particularly any EU-based investors that are interested in this subject and are interested in supporting an EU mandatory regime. And in particular, there are ways that you could get involved in this campaign, highlighting case studies of how you have already been carrying out due diligence and what kind of benefits it provides you, or how you protected yourself from risk through this due diligence. Any kind of public statement of support for due diligence would also be incredibly helpful. Other ideas could be op-eds in European newspapers or in Brussels-based newspapers, or it could be more behind-the-scenes kind of work. So talking to your national governments if you're based in France or Germany or the Netherlands or Italy, for example, talking to your national governments and expressing your public or your support for this mandatory regime. So I'll leave it there just to clarify in terms of the timetable, because I don't think I mentioned that. So as I said, this is currently being negotiated, and really it's within the next couple of weeks, potentially months, depending on how the negotiations go, that we could potentially see some progress on this. So I didn't actually include my email address, but maybe there's a way that we can send it round to participants afterwards, or hopefully Paloma and Mary can help me and send it out to those of you who are interested in contacting me. Many thanks.
Great, thank you so much for that. Lots to follow up on, and yes, we'll be able to share your email as a follow-up. Now I'd just like to move on to briefly have Sabrina and Lauren kind of chime in and share the reflections on what you all have shared with us, and also just brief examples on how they've integrated human rights criteria into their work. So Sabrina, great if you could just chime in, and I think we need to move on to the next slide for Sabrina's slides, Mary. Great.
Sure. Thank you, Paloma. So hi, everyone. My name is Sabrina, and I work in the portfolio management team of Sycomore Asset Management as an ESG specialist. And Sycomore is a boutique asset management firm based in Paris, specialized in listed equities and responsible investing, with about 7 billion of assets under management. And we invest, as I said, mainly in listed equity in Europe, but we also have some holdings in Asia and the US. And our main clients are pension funds and wealth managers. So as you can see from the slide, where we are describing our investment philosophy, it is centered around one belief, that is that value creation by a company is sustainable only if it's shared with all stakeholders. And this is why we developed a proprietary analysis tool, which we call SPICE, which stands for the 5 stakeholders of a company that you can see here. So each of these pillars includes several criteria, 80 overall, which include also human rights impacts. So I put here some examples to give you an idea, but it's not an exhaustive list. So of things we will look at. So for example, we will look at the overall application of the UNGPs by a company. We will look at its supply chain. We will look at the contribution a company can have to certain basic human rights, such as access to medicine or water. And this is where we see, for example, as Michelle mentioned before, the overlap with the SDGs as well. We also look at digital rights, very hot topic today, and so on. So these criteria and the related scores are then used by us to either select, exclude, or engage with certain companies. And so to go back to human rights, we found it important to identify very well human rights related criteria in our model, as we believe those are the ones where there are no trade-offs to be made. So to give you an example, at Sycomore, we have a fund that invests in companies that are particularly good when it comes to well-being at work. So for instance, we have identified a tech company that would have been a good fit for such a fund, but we decided after engaging with this company to not invest in it because of digital rights concerns. And this is also because we look at impacts from a right holder perspective. So the other speakers have been talking a lot about it, and this is something that is really dear to us, to make sure that we focus really on the right holder. And not only because it's our duty as responsible investors, but also if you want to be pragmatic, we find it very hard to say with certainty if a negative impact or an abuse that is taking place in an investee company won't have any negative impact on us as a shareholder. We really think we cannot say that with certainty, even if it's just from a reputational perspective. So finally, just to move on the next slide, is to show how our analysis that I just mentioned is really integrated in our financial model. As the result, the final score of the analysis impacts the beta. And thus we would give a higher beta to less quality stocks from an ESG, so to say, perspective, which then impacts the target price of the stock we analyze. And we do this really to make sure that the investment process is fully integrated and everyone in the team needs to complete the ESG and human rights due diligence. Otherwise, the financial model is also incomplete. And so this is how we do things today. And of course, it's not perfect. We're always trying to improve. And this is also why we are supportive of Global Witness work, of what Rachel has just said, because we wouldn't see it as an additional burden. On the contrary, we would welcome any initiative that would bring the conversation forward on what other public equity investors can do to enhance human rights due diligence and thus promote respect for human rights. And also, another way that this proposal would help us on a practical level is to give more legitimacy to our due diligence efforts, especially when dealing with internal and external stakeholders. So to give you an example, when we are in front of our investee companies sometimes, most of them, they have understood that it's important to have a dialogue on the environment, but some are still reluctant to talk about human rights. Or they believe, for example, that as they're operating in Europe, they shouldn't be concerned. So, and no questions will be asked. So if there is legislation coming in at the EU level, this would reinforce the need to answer certain questions, especially if then everyone, other investors, are also start to ask them as a part of a mandatory due diligence. So, and to conclude, we also believe that to achieve meaningful impact and real change at scale, we need everyone to get on board and be serious about it, because we are a small asset manager, so of course, no matter all the good intentions we can have, most of the time we don't have the necessary leverage to really change things by ourselves and change really the outcomes for people on the ground. So we are looking forward to see how we can support Rachel, maybe issuing a public statement, we were thinking, as we already discussed this. And thank you for listening, and I pass the word on to you, Paloma.
Great. Paloma, should I just chime in? Hi. This is Lauren Compere. I also sit on the steering committee of the Alliance. I want to sort of weave in some of the comments and some of the presentations we've heard here already. I actually had a chance last week to be part of a group giving expert testimony to the Liechtenstein Initiative, and this is a group looking of commissioners really looking at how the financial sector can leverage and address modern day slavery and human trafficking. And so maybe thinking about as investors where our leverage really is. I think it's important for us to not only talk about the S of human rights, but also really framing human rights as a governance issue. And I think by doing that, we've seen groups like the International Corporate Governance Network really look at the governance of human rights. I think it's really important for us to not separate human rights due diligence from stewardship activities. And one of the things we were looking at this convening last week in Liechtenstein, fun to say, is really looking at the continuum of investor leverage. I mean, I think as Boston Common Asset Management, we've really been focused on the ecosystem change, not only focusing on individual engagement, but really looking at holistically where are the intervention points that we as investors can influence. And I think it's important to focus on not just individual company engagement, but frankly, supporting rulemaking, supporting disclosure frameworks like Rachel has said, engaging the standard setting bodies like the OECD and industry groups, regulators, and really focusing on collaborative engagement. I think just one cautionary note is that our ability as investors to actually use leverage to address adverse impacts around human rights really relies heavily on two key points. One is the corporate, the individual issuer due diligence, as well as financial sector actors like banks conducting their own due diligence. And so I think focusing on what that looks like, under responsible business conduct, and what is the most relevant disclosure by those groups, I think is really important. And I think, as Barbara had alluded to, most investor links to human rights are really around linkage and not directly focused on cause and contribution. And so while officially, I think under the UN Guiding Principles, investors then would not be subject to, they're expected to use investor leverage and to do that collaboratively, which I actually think to the previous speaker's point, Sabrina, is that collaborative action, I think, is the most impactful, and that's why we've backed the alliance. But I want to say that we should also look at our ability to enable remedy, which is not actually something we've really talked about widely on this call. And that, in fact, we should look at creative ways of enabling remedy, whether it's our direct engagement with banks that are financing some of these more controversial projects, or corporations, or really enabling remedies for our own actions. For example, backing something like the Accord and doing on-the-ground due diligence in Bangladesh, as we've done, and as the ICCR and the Alliance have backed previously. So I think I'm supposed to be provocative and end with a question to the group. Where Barbara and Rachel, Sabrina, Michelle, where do you think as an alliance or as a group of investors we should really focus on leveraging our platform? Where should our leverage be focused? And do you have some thoughts of initiatives that are already looking at, for example, an investor's ability to help enable remedy happen? And then how do we bring up the laggards in this space? Because one of the things that I always am concerned about is that the national contact points are stronger in Europe than they are in the U.S. And so I think our use of that leverage, in terms of national contact points, are limited a bit here in the U.S. And any thoughts on that? So Paloma.
Great. That's a good broad question. Maybe just ask the sort of speakers to quickly chime in with their thoughts on Lauren's questions, and then we'll open it up for the round of questions. But we already have actually a long list of questions, so let's do it like that, if that's all right. Barbara, would you like to get us started?
Sure. Thanks. Well, I mean, I think from the perspective of the OECD, it's always very useful to hear from actual practitioners in the community about how we can support them and how we can help take this agenda further. All our work is mandate-based, so we can't pursue anything without a clear demand that often comes directly from practitioners, but sometimes is then channeled through policymakers. So I think in terms of where to focus, I would just say as a general point, it's important for investors to be explicit about what their needs are from policymakers and international institutions. What we've been hearing a lot is that some of the principal challenges to RBC due diligence and more broadly ESG integration is that, number one, there's lack of clarity in terms of investor governance about how far investors can go and whether, they can be at liberty to take into account environmental and social issues in this relationship between those objectives and also commercial returns, the relationship between that and time horizons for measuring returns of investments. So doing a little more work on being more explicit on what investor duties are and allowing space for them to integrate environmental and social issues in their decision making. I think that's a really important place for policymakers to start. Another thing we've noticed that seems to be a challenge for investors is a lack of widespread standards on this. So it seems like there's different understanding across jurisdictions and different communities on what ESG integration or RBC means for investors, and everyone is sort of pursuing their own approach, which is good in the sense that it allows flexibility, but at the same time, it also potentially allows for sort of potentially greenwashing or approaches that aren't effective at the end of the day. So I think multi-stakeholder processes and also international processes that try to define standards of conduct as benchmarks for RBC are an important place to start as well. And then lastly, this hasn't come up at all on the call, but of course the issue of data continues to be a challenge, I think, for investors. Having, I guess, quality data on environmental and social risks so that they can be adequately taken into account in decision making is a problem. And it's somewhere there's been progress made in the context of climate risks, it seems like. And I think there's opportunity to sort of take some lessons from what's happening in the climate space and apply it to risks more broadly to give investors the tools that they need to identify these risks appropriately. So those are maybe the three areas I would start with.
Great. I don't know if anybody else wants to chime in, Rachel or Sabrina.
Yeah, it's just a brilliant conversation. I'm really glad that we've done this, and maybe we'll need a follow-up because there's so many points to raise. But I think I'll just focus on a couple. I think one response to Lauren's point, I think you make a really, really strong point, and I think just to echo what Barbara said, I think that's why we need, to be honest, global standards. I focus on trying to achieve EU mandatory disclosure because I believe that that is not only going to benefit kind of EU investors in terms of legal clarity and having this framework and kind of dealing with the laggards issue, but also I hope sets a precedent globally for the need for these kind of due diligence requirements. I think the point about company disclosure and companies' roles is a really important one. And actually in the EU next year, there will be a review of the EU legal framework around European company reporting. And we see these two issues as very much interlinked, and we will be supporting efforts to ensure that companies are disclosing the right information for investors. But we also think that by actually putting this requirement, making this requirement mandatory for investors, that creates a really important demand in the market for companies to produce the information needed in order to do this due diligence. So we feel like it's almost like a circular exercise. I noticed there was a question from some of the participants about how this EU work relates to the current French law, and I presume by that they mean the duty of care law. But there is also the Article 173, which is about climate risk disclosure. So I'm not really sure which French law, but just a quick note to say on the duty of care law, which is all about companies doing due diligence, we feel that that's a really important framework and would be very supportive of something similar at a European level, but that's focused on companies, so it's not about the role of investors. What we're trying to achieve with the initiative that I was talking about is trying to achieve this framework for investors. And what I would say about the Article 173 law, if that's the one you're referring to, that's about investors in France disclosing their climate risk. There's some strong points about that law. We haven't studied it in detail, but one of the major weaknesses is that it's comply and explain. Whereas I think, as Barbara was talking about, what we really want is a kind of behavioural and cultural shift, so that investors are doing, just as Sabrina was talking about, really integrating these environmental, social and governance risks into their everyday decision making. And we also want that to apply across the board. And so Lauren mentioned banks, for example, or was it Sabrina? I couldn't remember, sorry. But one of the things we're advocating in the EU law, and actually in the current proposals, although it's still to be agreed, banks are in scope when it's using their own investments, but not for corporate loans. Yeah, I'll leave it there. Thank you.
And it's Michelle. If I could just jump in here, and again, maybe to respond to something that I know is in the question box at the moment. Two thoughts from an investor perspective about the value of work on this. One is going back to the standards question. People have been asking, how is this different from GRI? Can companies simply decide not to undertake due diligence? The interesting point about the OECD guidelines is that they simply exist whether or not a company or an investor chooses to interface with them or not. A person who, or a stakeholder who feels that they have a grievance, can bring a grievance against a company or an investor, regardless of whether they have even that company or investor has even heard of the OECD guidelines, and that is a big difference, I think, from some of the other voluntary standards out there, and that creates an interesting new dynamic. When it comes to what I think needs to be done, I'm a big advocate for that we need to start with education on this. That's one of the reasons why we wanted to be involved in the Alliance, as an opportunity to educate ourselves and educate other stakeholders in the investment space, and work together with colleagues to try to establish what are good standards and what is a good level of due diligence in relation to human rights. And because this is a very new space, to work together to try to explore some of these issues, and to bring more investors and more in the investment community on board and into those discussions about how we should approach these issues.
Excellent. Thanks for that. I think, yeah, some of the questions that were in the question box were answered. Maybe I'll just then highlight those that weren't referred to. And I'll start briefly with some of the questions that were for you, Barbara. First, I think there's a question around the scope and the tools for investors around due diligence. One question is that given the breadth of potential human rights issues and the limited resources of both companies and investors, how can we narrow the ask when it comes to human rights due diligence with companies? Is there, for example, a subset of rights that are best to start with? And then this was kind of related to what Michelle was saying, and how does this all relate to, other reporting processes and tools like the GRI? That's one set of questions. There is a second set of questions that really touches also on what Michelle was alluding to, but maybe there's an opportunity to highlight a case that's more specific. Have there been NCP cases against socially responsible investors or impact investment groups? So really the issue of accountability for institutional investors under OECD. There's also a clarification question for you, Barbara, around did you say the high-level guidance didn't address the sector-specific concerns, so investors didn't find them relevant for portfolio management and thus the sector-specific approach, or did you say that they still didn't find the sector-specific work helpful? Those are kind of some main questions there. Then there's a there's a couple of questions that I've bunched together around, corporate due diligence in particular, and then I think this is applicable to anyone who wants to respond to it. Some companies resist doing due diligence because of the fear of legal exposure. So, how do we break away from this paradigm? And do companies need a standalone human rights policy, or can it be integrated across other policies? And finally, how do we go beyond the audit protocol? So really just questions around what's best practice or what's meaningful due diligence. So those are more or less for everyone. And then Rachel, just one question for you here around the Southeast Asia case study project. If you could share a little bit more about those case studies and specifically, what are you looking for in terms of collaborating with investors on these? And then Sabrina, we have a question for you. Does the low SPICE score result in engagement or divestment? So that's really the first round of questions that we have. I invite participants to ask further questions in the box, and then we could have a second round if time allows.
Shall I go first, or because
Sure.
I think mine was quite quick? Sure. Yeah, I just well, firstly, I'll answer the questions, but I also, before that, I just wanted to mention that the UN Principles of Responsible Investment have a quite helpful framework, because some people are asking, which human rights risks should you consider? And they've actually got this non-exhaustive list of different risks. And we found that quite a helpful framework for investors to actually kind of look at. It's not that detailed, but it's kind of like a list of different risks. So things like land grabbing, threats to local communities, biodiversity issues, and that could be a place to start. And what we've always said is that it's actually obviously for investors to use this 6-step process in the OECD to develop quite a flexible process, because every investor is different, and it's different if you're a pension fund or you're an insurer or you're an asset manager. And the other thing, but then I would say to look at that list of risk as a starting point, because I do think it's been established and it's a UN list if you have me in, and I think that's a good place to start in terms of what the different risks are, and then kind of thinking about what the risks are specific to the sector that you're investing in. So there was a question about the case studies. So the two reports that I mentioned were, one was called Rubber Barons, and that we produced in 2013, 2014. That can be found on our website, which I'll just give you the address to, is theglobalwitness.org. There's also another more recent case study briefing that we did in September last year called Indecent Exposure, and that highlights 4 different case studies across the world, in India, Africa, Southeast Asia, and so on. And in terms of how investors can get involved, I mean, it's really the point I was talking to right at the end in terms of slides. So if this is something you think you want to get involved in, please do contact me. My email address is rowen, so at globalwitness.org. And what we're really looking for is either public or private support from institutional investors, particularly those based in the EU, as obviously that's more, that's the kind of immediate negotiations that are happening. And really kind of getting involved and going to speak to your finance ministries in favour of this EU mandatory due diligence regime. And we can send you more details if necessary. Thank you.
So maybe I can answer the question on the SPICE. Our SPICE model defines the companies that we want to target, both from a selection and exclusion standpoint. So we're going to really go and try to invest in our funds in the companies with the best scores, and when the companies have really low scores, we're going to exclude them from our universe. But we're always going to do that after engaging with the companies. So we always try to engage first, because first of all, we want to address our concerns, and secondly, we want to make sure we've done our analysis properly and we're not penalizing a company just for lack of transparency, for example, which is the case, for example, with small companies. So I hope this answers the question.
This is Lauren quickly. I wanted to get back to a point that I had made, and also that I think Barbara highlighted this lack of this lack of quality data. I think is really critically important, and I think this kind of chicken and egg or circular kind of challenge we have. Our ability to conduct human rights due diligence relies on quality data, relevant disclosure, and so in whatever sort of global standard, you're advocating for and guidance, it needs to not just apply to institutional investors. There needs to be an explicit, understanding and call out that our ability to do this relies on really relevant disclosure and relevant, human rights due diligence being conducted by both companies and other financial service actors. And so to the extent Rachel or Barbara, you can comment on that or make sure that that kind of messaging is brought back to the work that you're doing, I'd appreciate it.
Sure, I'm happy to. Oh,
go ahead, Rachel.
Sure, sorry. I'm happy to answer that. No, it's a really good point, actually, and it's very much a live debate here in the EU. So when we're having these discussions, exactly, there's this point where it's a kind of two-sided coin that investors need the information coming from companies as well. And actually, within the disclosure regulation, the European Parliament has voted for an amendment which is requiring this information to be disclosed. Again, that's something which we don't know whether it will stay in throughout the negotiations. It's certainly something we support as well. But if it doesn't happen this time round, then as I said, the corporate reporting is going to be reformed in its entirety in the EU anyway. And already we've had strong indications from the European Commission that that would include much more disclosure from companies on particularly this kind of non-financial aspects, as they call them, which is things like the environmental, social, and governance risks.
Yeah, and maybe if I can come in on that point as well, I think it actually relates to a few of the other questions that were raised. Something that we're trying to do at the OECD is to think about how to link up our work on the financial sector with our other sector projects that we have ongoing. So those are projects in the garment, footwear sector, agriculture, and extractives. And in each of those, we really have a big community of practitioners, also experts on specific risks in those sectors that are promoting best practice and thinking about all these issues from that perspective, that sector. So potentially having some sort of exchange or connection between those communities to help investors identify maybe what the most important risks are with respect to the question on where to focus first, but then also to have a discussion mutually about how to communicate on those risks in a way where the data can really be used by investors, can be useful. And that's something we're thinking of moving forward on. I think there was a lot of other questions for me. I'll address some in just the few minutes that we have left, and maybe just leave a few minutes at the end for any closing remarks. But there was maybe I'll start with a question just on the clarification about how the general versus specific standards relate to one another. What I was saying is that in the actual guidelines themselves, the OECD guidelines for multinational enterprises, the provision on due diligence is very minimal. There's not much language around that. And we've launched these sector projects to sort of explain what this means in the context of specific sectors and specific types of practitioners. But that being said, we've also developed general due diligence guidance that can be applicable for any sector. So ones that we don't cover specifically by sector projects. And it can also be a supplementary resource for investors in addition to the investor paper. One thing about the due diligence approach, which I think is useful, but in some senses also sometimes uncomfortable also for companies, is that it's meant to be flexible. So with respect to the question on policies, whether it has to be one policy or a variety of policies, we leave it up to investors to decide what works best for them, provided it meets certain standards and includes certain information. We've noticed in the financial sector, in banking specifically, it's usually a series of policies versus just one central policy, and that's really fine as long as they're publicly available and cover certain types of information. And that's the same issue for reporting as well. So we have a broad sort of high-level recommendation on the type of information that should be reported. And then how it's reported, we, again, sort of leave up to the company. That being said, we've been working really closely with other organizations that focus on reporting. So GRI currently is in the process of amending its human rights disclosure framework. And we're part of their advisory group to ensure that there's alignment with the due diligence approach. We're also involved with Global Witness in the conversations happening at the EU level right now, again, to make sure that there's alignment so that investors don't have to modify their reporting across various different frameworks, hopefully. And then there was a question whether there's been a case brought against an impact investor, an SR investment. Not to my knowledge, I don't think so. Most of the cases regarding the financial sector have dealt with mainstream investors, investments as well. But for some reason, the question reminded me that recently we've had a couple of cases targeting social auditors. So there's been two separate cases, one at the Danish NCP, one at the German NCP, that targeted social auditors that were involved in Rana Plaza in a different issue in the garment sector. And those sort of indicate to me that there is now starting to be a higher level of scrutiny on practitioners that have social objectives and then don't necessarily implement them. So it might be something that we see in the context of investors as well. And then I think, well, we're almost out of time, so I'll leave it at that and let others jump in on the remaining questions. Thank you.
Yeah, are there any other comments, or Michelle or Lauren, in relation to the questions around corporate due diligence and the expectations there for investors? It's 2 minutes left, so
no, I like Barbara's idea of linking up those conversations at the sector level and coming up with some guidance or insights for investors.
Great. Okay, I think we're going to need to wrap it up. There are a couple more questions, but I'm happy to connect everyone offline and share emails and so forth so the discussion can be taken forward. And hey, I think another webinar on this topic is certainly in order. So with that, I'd really just like to thank all of the speakers and discussants on this call. Your contribution has been invaluable. I think there's definitely a lot of follow-up that we need to do, particularly in relation to the ways that the Alliance and members of the Alliance can support the common human rights due diligence framework across the EU in particular, so more soon on that. And as I mentioned earlier, this webinar is really part of our larger effort within the Alliance to promote corporate respect for human rights. So with that in mind, I'd like to invite particularly the institutional investors and investors who are on the line who are not already part of the Alliance to join the Alliance. There's the link to the Alliance website and the sign on there. And of course, don't hesitate to get in touch with me should you have any questions or comments in relation to this work, this work stream in particular, but also the Alliance more generally. So with that, thank you all again for joining us today, and I'm wishing you a good day.